By way of review, guys, let's take a look at what we have done so far. Last meeting, we were able to compute for the net operating working capital, the total operating capital, and the investment in operating capital. Let's quickly review how we arrived at these figures. We said that in most finance text, working capital is equated with current assets. Net working capital is simply the difference between your current assets and current liabilities. For our purposes, we need to compute for the net operating working capital. Now take note that there's this inclusion of this descriptor, operating working capital as compared to net working capital. So how did we compute this last time? Last meeting, we learned how to compute for the operating current assets and then the operating current liabilities. So we have here our total current assets for advanced technologies. We have here cash and cash equivalents, short-term investments, accounts receivable, and inventories. So of these four current assets, only cash, AR, and inventories will form part of your operating current assets. Your short-term investments is a financing, involves financing activity, so it will not form part of your operating current assets. If there was prepayments here, because those are the 5 types of current assets, prepayments will still form part of your operating current assets. Okay, so in this case, only the 3, cash, accounts receivable, and inventories, are included as part of your operating current assets. So for 2020, we added the 10, 371.2, and 615 for your operating current assets. That's why we got this. Let's take a look at this formula. So it's adding the cash, and then this is your receivables and inventories. We skip the marketable securities. Same thing for 2019. So we have this operating current assets. Now, as regards operating current liabilities, we notice that advanced technologies had 3 total current liabilities, namely accounts payable, accruals, and notes payable. And we said that of these 3, only one will not form part of your operating current liabilities, notes payable, because notes payable is interest bearing. Accounts payable is part of operations. It's trade payables. It's generated in the course of the operations of the company. When a company is given an account, terms by the supplier of the raw materials, etc. Accruals also is in the context of the operations of the business. So it's expenses already incurred but not yet paid by the company. So these 2 were the only component, are the only ones considered as far as operating current liabilities is concerned. So we added these 2 and excluded the notes payable. Okay, that's how we got this 200 by adding the accounts payable and the accruals. So we get the difference between the 2, and that's the net operating working capital. Okay, so take note, guys, that the operating working capital increased from 2019 to 2020. Okay, it increased by this amount. The increase was around 150. That's actually 150 million because our data is our balance sheet and income statements is in millions. Okay, now next we go to the total net operating capital, otherwise known as TOC, total operating capital. And we said that the formula for this one is the one that we computed a while ago, net operating working capital plus your net property, plant, and equipment. Now, last time we said that property, plant, and equipment can be presented in 2 ways. This one, it can be presented in this way, okay, or just this. For the first one, you're given the PPE at cost. So this is the acquisition price. And then we subtract the accumulated depreciation, which, as we defined last time, is a contra asset account, okay, to get the net PPE. Now, usually, especially for a manufacturing firm, there are many PPE items. So what will happen is that you'll have notes to the financial statements identifying the several equipment, machinery, or other long-term assets, PPE assets, and then with their corresponding accumulated depreciation. Okay? So the other way is to just present net PPE, but of course, definitely there will be notes to the financial statements with this presentation. Okay, the formula for TOC, guys, total operating capital, is NOWC plus net PPE. So just a word of caution, if you're given in the balance sheet the at cost PPE, you have to add to NOWC not the at cost PPE, but rather the net PPE. So just follow strictly the formula. Okay, so here we see that from 870 to 1,000, company indeed invested in property, plant, and equipment. Okay, so TOC, guys, increased from 1516 to 1796.2, and thus we were able to compute for the investment in TOC just by getting the difference between the two. So this was the total operating capital at the beginning of the year. Okay, and then at the end of the year, it jumped to 1796, indicating there that management received more operating capital from their investors to the tune of around 280 million. Okay, so this is indicative that the company was investing more in their operating assets. Okay, now we look at the difference between NOPAT and NIAT, net income after tax and net operating profit after tax. Okay, so net income after tax, that's the same one we see in the income statement here. This is net income after tax. So we just copy this, guys. We just copy this. We start with the EBIT less interest, okay, and then we have earnings before tax, and then taxes, and then net income after tax. Okay, so let's copy that. Net income after tax, we start with earnings before income, interest and taxes, so that's your operating income. So we have this one. Okay, and then okay, and then either we can just copy it to the right here and copy down also because of the same position. Oh, sorry. I'm sorry. We're not copying 2019. Sorry about that. Let me just to be consistent with the formatting of the so our EBT, of course, will be, okay, we can just subtract. And then tax, what's our tax? Will be the earnings before tax multiplied by the tax rate. Remember that we have given a name to the tax rate, so let's just use that. And then the net income after tax is just the difference between the two. So we're just copying what we have above because it's the same. It's your net income after tax. Okay, so 137.1, the same as what we have in the income statement above. That's your net income after tax. So no no other computation for that one. We just copied the one above. Okay, now for this one, NOPAT, net operating profit after tax. As the name indicates, guys, again, we're qualifying our profit. We want operating profit, net operating profit, and then that's after tax. Okay, now how do we do this, guys? So if we start first with EBIT, okay, let's not copy the format. Okay, now for net operating profit after tax, okay, it's unfair, guys, to charge operations with the interest expense because that's outside their control. They do not, they're not the ones that borrow. Okay, it's a function of finance. So in order to assess operating performance fairly, okay, we're not going to charge them with the interest expense. In other words, guys, interest expense, since it's a financial function, we're not going to charge operations with the incurrence of the interest. So it's we're assuming as if the company has no debt. Okay, so that's the implication. Or here we're saying that there's interest, which indicates that there's debt, but we're not going to charge operations with that. Okay, therefore, what happens is that your EBT, your earnings before tax, will actually be equal to your EBIT, since we're not charging it with interest. Okay, so let's compute now for the tax. It's equal to this amount times the tax rate once again. Okay, and then the NOPAT will be equal to this minus this. Okay, so we now have the computation for the net operating profit after tax. Okay, if you notice, guys, number one, NOPAT is higher than net income after tax. That happens when your EBIT is positive. So the net operating profit after tax is higher than your net income after tax. Okay? And also your tax, guys, for NOPAT is higher than your tax for your net income after tax. Let's see the difference. By how much is your NOPAT greater than your net income after tax? As we can see here, your net operating profit after tax is greater than your net income after tax by 61.6. However, guys, in terms of tax, we notice that the tax for NOPAT is higher than the tax for net income after tax. Okay, that's, of course, that's obvious because the earnings before tax for NOPAT is higher because we did not subtract interest from that. Now, my question is, we did not charge NOPAT with interest. So we might be tempted to think that NOPAT should be greater than interest by 88, which is NOPAT should be greater than net income after tax by 88, in this case 88 million, because of the interest charge that was not, interest expense that was not charged to it. Now, that's not the case, guys. That's not the case. So what happened here? Why is now your NOPAT greater than your net income after tax, not by the whole interest expense? What happened here was, so if this was interest expense was 88, okay, a certain percentage of that, guys, resulted into tax savings for the net income after tax. And that the tax savings was 30% because the tax rate is 30%. Okay, so the balance of this one minus the tax rate, or 1 minus 30% is 70%. Okay, so the difference now between, assuming this is 100%, the difference between your NOPAT and your NIAT is that your NOPAT will be greater than your net income after tax, not by 100%, but only by 70%. Because your NOPAT will be higher in terms of tax by 30% compared to your net income after tax. So let's see. Let's see if that makes sense, guys. Let's prove that by, okay, interest is 88, okay? The tax rate is 30%. So it's equal to tax rate. Okay. The tax rate is equal to 30%. Let's just make this as decimal. 30%. And so the difference between 100% and 30%, that's 70%. Okay. So 88, which is the interest expense, 30% of that, okay, went to tax savings, Sorry, have to fix F4. Sorry, wrong formula. G92 is the one that I should have fixed. Okay. Okay, so we looked at 88, the interest expense, because this is the difference between your net income after tax and your NOPAT. Okay, now looking at the bottom line, your NOPAT is higher than your NIAT, not by 88. It's only by 61.6. Why? Because we said that the interest expense, okay, not all of that will be added back to NOPAT. Not all this 88 interest expense will be the difference between NOPAT and NIAT. Only 70% or 1 minus the tax rate. Because your NIAT will have a lower tax rate. Okay, this tells us the leverage effect of debt. Okay, so the use of debt, guys, the use of utang reduces your tax. So there's tax savings because of the use of debt. Okay, so it leverages the operating profit of the firm. Okay, so in order to answer the question, what's the difference between NOPAT and NIAT given the tax rate and the interest expense? You can easily compute for that, guys. It will simply be the interest multiplied by the 1 minus tax rate. That will give us the difference between your NOPAT and your NIAT. Okay, so let me pause for a while, guys. So far clear ba to? Any questions? Please feel free to chat, guys, to ask your questions. And if you have no questions, guys, I would appreciate you chatting there. Yes, if it's clear so far. Kindly chat, please, guys. Kung clear so far ba yung discussion natin. Okay, thank you. I hope the others also give their feedback. Okay, so let's wait for a few more responses from your classmates. Okay. Oh yes, Lance. My question to Lance, if I post the recording. Yeah, guys, take note that all the sessions that we have is posted in our Canvas. Okay, so I'd like to encourage you to view again, guys, yung ano natin, yung sessions natin, kasi lahat naman, everything is posted in Canvas. Okay, so I hope so far our discussion is clear. No? Now, how did we compute for the NOPAT? We looked at EBIT, okay, and then we subtracted interest expense, which is 0. So we have here our EBIT will be the same as your earnings before tax, and then we just deduct it with tax. Okay, so it's just the same as using the EBIT, okay, and then subtract the tax, right? So let's do that, guys. Okay, so the shortcut is just EBIT times 1 minus tax rate. So I'm going to copy EBIT here. EBIT. I'm copying here so that I can also compute for NOPAT for 2019. Okay, so we can copy that to the right. This is your NOPAT for EBIT for 2019. Then this is equal to this one multiplied by the tax rate. And we can copy that to the right. Therefore, our NOPAT is simply the difference between your EBIT minus the tax rate. And then let's there, just to be consistent with the formatting. Okay, so we say, guys, that NOPAT increased, guys. It increased by from 184.1 to 198.7. Let's see by how many percent it increased. So 2020 figure divided by 2019 figure minus 1. This gives us around 8%. So NOPAT increased by 8%. Not bad, guys. Operating profit increased by 8%. Of course, guys, we say that we cannot assess that in a vacuum. Okay. So actually, I was wrong when I said not bad, because I have to compare that with previous years, increase in NOPAT, and then also compare that with the benchmark companies, with their direct competitors. All I can say here is that NOPAT increased by 8%. Okay, so far clear, guys, yung NOPAT, yung formula, it's just EBIT times your 1 minus tax rate. So from your EBIT, we just deduct the tax on the EBIT to get your net operating profit after tax. Okay, and comparing 2019 and 2020, we say that there was an 8% increase as far as the operating profit is concerned. Okay, next, free cash flow, guys. What is free cash flow? So let me just write that here. Free cash flow is cash flow available for distribution to investors, okay? After deducting cash flow requirements for operations. Okay. So that's how we define free cash flow. Let me color that. Okay. Free cash flow is cash flow available for distributions to investors after deducting cash flow requirements for operations. Okay, so again, we qualify the word investors. When we say investors, who are these guys? We know that, guys, that investors are your creditors and your shareholders. Okay, so these are our investors. Okay, so again, guys, for the last time, free cash flow is cash flow available for distribution to investors after deducting cash flow requirements for operations. So let's identify here 5 uses of free cash flow. Okay, anybody, guys, would like to volunteer? What do you think are the 5 uses of free cash flow based on the definition? Cash flow used for distribution to investors after deducting cash flow requirements for operations. So anyone? Volunteer, guys? What are examples of uses of free cash flow?
To repay debt.
Okay. So repay debt. Who was that? Sorry.
Angelica po.
Angelica. Okay. Angelica. What type of debt, Angelica?
That I'm not too sure po.
Sige. Kasi sabi natin, di ba? May layers yung debt, no? Sige. Sulat natin, maybe Angelica was referring to payment of interest, di ba? Kasi pag utang, guys, may interest yan, di ba? So, free cash flow is used to pay off interest incurred because of the borrowing. Thank you, Angela. You're correct, no? So when a company borrows, especially for long term, there are interest expenses that come with it. So free cash flow is used for the payment of interest expense, cash payments to creditors. Okay, thank you, Angela. What else, guys? What else? Anyone else, guys?
Sir, to pay dividends po.
Okay. So that's for the shareholders, no? So let's see, that's distribution, distribution of dividends. Okay, thank you. Who was that?
Chloe, sir.
Chloe. Chloe, thank you. Okay, who else, guys? Any other uses? Any other use of free cash flow? We have identified two. One is for creditors, the other one is for,
Sir,
yes, Angelica?
buying investments.
Buying investments, okay. What kind of investments? Is it for operations?
Short-term investments.
Okay, sige, sige. Pwede yun. Kasi kung for operations siya, hindi nakasama sa, it's not part of free cash flow because we already deducted it for operations. So let's call that investments in non-operating assets, okay? So the general description for that is investments in non-operating assets. Example niyan, short-term investments. It's correct. No? Okay, two more, guys. Let's identify two more uses of free cash flow. Anyone else? What about for creditors again? We mentioned only interest payments. So is there any other thing that we should pay creditors?
To pay off debt, sir.
Yeah, pay of debts, or what's the word for that? Thank you. Thank you, Angelo.
Yes, sir.
Payment of what? Payment of,
Loans.
what do you call it, guys? Payment of the debt itself, or the letter P?
Bonds.
Angelo,
Principal, sir.
the what? The principal, diba? Principal payments. Okay. Kasi if a company issues bonds, for example, it borrows, let's say 100 million, that's called the principal. And then the company on regular time intervals will pay its interest payments. And one last one, guys. How about for shareholders again? We discussed this before. Aside from dividends, the company can opt to
Reinvest, sir.
reinvest. Okay, but that's not for shareholders. It's what? It's, we mentioned this before, guys, buyback, right? The company can buy back shares of stock, which we call treasury, treasury stock. They can buy back the shares of stock owned by the shareholders. Okay, so these are five the major uses of free cash flow. Okay, and we can compute for free cash flow, guys. How do we compute for free cash flow? Okay, so the formula here is you start with the NOPAT, and then based on the definition, free cash flow is cash flow available for distribution to investors after deducting cash flow requirements for operations. So we start with the net income after tax, and then we subtract how much cash flow is needed for operations for this particular year. Okay, so let's do that. So for 2020, our net operating profit after tax was 198.7. So we just get that from row 195. We already computed for that. Okay, and then how much was invested for operating capital? Because by definition, we said that free cash flow is the leftover amount that's available for distribution to investors after we deduct cash flow requirements for operations. Now we can get that from this one, investment in TOC. Okay, take note, guys, that at the beginning of the year, the company had TOC, total operating capital, of 1516. Okay. At the end of the year, they had 1796. So there was an increase, okay, in total operating capital. In fact, I think, did we compute this a while ago? The increase in total operating capital was, okay, so it increased by 18%. No? So the company was now investing in operating capital, particularly investing in its current assets and investing in its net plant and equipment. Okay, so total increase in operating capital was 18%. So this is what we will be deducting from NOPAT, okay, because this was the investment in operating capital. Okay, so let's get that. So this is equal to how much was invested in operating capital, 279.8. Okay, so free cash flow will be equal to this one minus this one. Okay, so let me just format that for better appreciation. Okay, all right. We have a free cash flow of negative 81.1. Okay, then the next question is negative free cash flow, good or bad? So that's the question we have to answer. Because this indicates that technically there is no cash flow available for distribution to shareholders because this is negative free cash flow. So is this good or bad? So this is a very important question for us to answer. Good ba siya o masama ba siya? This negative free cash flow. Okay, anyone would like to give his or her insight on that or opinion about that? Is a negative free cash flow good or bad? Okay, so in the interest of time, guys, let me just elaborate on this. Now, in order to answer this question, we have to ask ourselves, where was the source of the negative free cash flow? Okay, because there are only two items that dictate the free cash flow. One is NOPAT, and the other one is net investment in TOC. So let's first take a look at NOPAT. For NOPAT, guys, we have our computation here. NOPAT, you notice that EBIT was positive, which means, okay, so let's look at EBIT. Let's look at our income statement. This is our EBIT, guys. And how do we compute for EBIT? EBIT is computed by subtracting from your revenues all your operating costs. Okay, that's why this is also called operating profit, earnings before interest and taxes. Okay, so we subtract operating cost and here also depreciation operating cost. So our total operating cost here is 2716. Okay, where did I get to 2716? This plus this one. So our total operating cost was 2716 for 2020. Our sales was 3,000. So we were able to generate sales over and above, greater than the operating cost. That's why we have an EBIT of 283.8. So fair enough. Okay. In fact, it increased by compared to 2019, it increased by how many percentage points? Okay. It increased by around 8%. Okay. So our EBIT increased by 8%, comparing 2020 and 2019. So it seems that our EBIT is okay. Okay. And EBIT is the source of our NOPAT. Okay, so going back here, guys, I'm sorry to be moving from one part to the other. Okay. So EBIT is okay. It looks like NOPAT is also okay. 198.7. Okay, this is our EBIT. Our tax rate is 30%, 198.7. Okay, so as far as NOPAT is concerned, we don't seem to have any issues with this one. Now, how about net investment? Okay, so the reason why free cash flow is negative is because the net investment is higher than your NOPAT. Okay? Okay, let's take a look at net investment. This one. 279.8 because the operating capital increased in 2020. At the start of the year, there was 1516. At the end of the year, it was already 1796.2 for a total increment of 279.8. Okay, so it was increasing, it increased by around 280. Okay, so in that case, guys, our free cash flow was negative because the company was heavily investing in its operating assets. And that could be a signal that the company perceives that there will be greater sales, not only this year, but in the near future. How do we know that? Guys, take a look at their investment in net plant and equipment. There was an increase of 130 million. They invested in net plant and equipment. Okay, they also increased in their operating working capital. So the company was heavily investing in their receivables, in their inventories, and also in their plant and equipment. So that's a signal that the company was expecting that there will be an increase in demand for their product. They were expecting that the market share will be growing. Okay, so the free cash flow is negative, guys, does not indicate that the company is performing bad. Okay, it has to have a deeper analysis. In this case, it turns out that the company was heavily investing in their operating capital, and that's good because there is a signal that the company expects an increase in demand for their product, increase in market share, increase in revenues. In fact, their NOPAT is also okay. Okay, so of course, guys, the ultimate is to compare the NOPAT and the net investment with other companies. And of course, compare this also with the previous year. But at face value, we cannot say that a company has a bad FCF if it's negative. A negative free cash flow does not automatically mean that the company did not generate enough free cash flow. Here in this case, we say that the negative free cash flow is borne out by the company heavily investing in its operating assets. And that's needed, guys, in order to support its sales. Okay, imagine if the company does not invest in inventories. Okay, invest in receivables. Okay, which means it does not give credit terms. Okay, then that might impact their operating performance, their sales generation. Okay. So in this case, guys, I said, guys, I dare say that the company is performing well. In fact, this increase in TOC is an indicator that the company is heavily investing in order to prepare itself for future greater demands. Okay, so which is good, A negative free cash flow will not be good if in the first place the NOPAT is negative. So when will the NOPAT be negative? If the EBIT is negative. If the EBIT is negative, then automatically your NOPAT will be negative. If the NOPAT is negative, then definitely your free cash flow will be negative. So in instances like that, where the company fared poorly as far as operating results is concerned, then that's indicative of a poor free cash flow. Okay, so let me pause for a while, guys, and check if I'm clear so far with the discussion of free cash flow. I would appreciate, guys, you commenting in the chat box if so far clear yung negative free cash flow discussion natin. Or if you have any questions. Okay, thank you. Okay, thank you for the responses. Thank you so much. Appreciate the responses. Okay, thank you. Good. Good. Okay, so let's now go, guys, to ROIC, return on invested capital. So we're going to go back to our question. Okay, let me write the question, guys. did management create value for shareholders? So this is a very important question which we need to address, which we need to answer. Was management able to create value for shareholders? Now, in order to answer that, guys, we have to have certain metrics. And the metrics that we're going to use for that is, we're going to use three in this case: ROIC, and then MVA, and EVA. Okay, so these three metrics: return on invested capital, and then we have here MVA, market value added, and also EVA, economic value added. We're going to use that in order to answer the question if management was able to generate or create value for the shareholders. Okay, let's start first with the ROIC, return on invested capital. Okay, so there's a story behind this, guys. Okay, so take a look at the formula. It's NOPAT. So we're going to assess the performance of the firm based on their operating profit. Okay, so it's NOPAT, okay, divided by the TOC beginning capital. Okay, let me begin with the TOC beginning capital. Let's draw out the story here. Okay, so in 2020, okay, which is the current year as far as advanced technologies is concerned, on January 1, okay, management provided the firm with, I think it's 1516.2. Kindly check, guys. So this is operating capital, okay, TOC. This is the beginning. So at the beginning of 2020, let me check, let me violate that. Okay, this one, yeah, 1516.4, sorry. 1516.4. So the firm provided management with this operating capital, TOC. At the end of the year, December 31, this already increased to okay, sorry about that, 1796. 1796.2. 1796.2. So this was operating capital provided to management. Okay, now we're going to assess management, okay, and we're going to just base it at the beginning of the year. It's like the story here, okay, we provided you with money. We provided you with capital worth 1,516,000,000. 1516 million. That's what we provided management with. What did they do with that capital? Okay, and then we're not even going to assess you based on net income after tax. We're going to assess you based on your operating profit. Okay, so how much profit was generated by the firm? Okay, in 2020, for the whole of 2020, so from January 1 up to December 31, okay, the company generated a profit, operating profit, guys, of 198.7. Okay, so this is operating profit. Okay, and what capital did they use? 1516.4. Okay, we're not looking at the end of the year. Okay, so because that's already the end of the year. So we're just saying at the beginning of the year, we provided you with 1516 worth of capital. How much operating profit did you generate out of that? Okay, and the profit generated was 98.7. Okay, so what we're going to do is we're going to get the ratio. Okay, so out of 1516.4, how much profit was generated? Okay, so let's first get the NOPAT for 2020. It's 198.7. Okay, and how much was beginning capital? Okay, we have it here. It's in row 70 here, 1516.4. Okay, so ROIC is, let me just increase. ROIC will therefore be, it's the ratio between how much operating profit was generated divided by how much capital was given. Okay, so we have an ROIC of 13.1%. Okay, so question, did management provide value or create value to their shareholders? Was value created? Anyone? Any suggestion? Any idea about that? Any opinion? What do you think, guys? Is an ROIC 13.10% okay? Was management able to create value for the shareholders? What do you think? Any suggested answer? An idea? Can unmute yourself, raise your hand, or type in the chat box. What do you think, guys? ROIC is 13.1% based on our computation. Okay. The company generated no PAT given the capital of 1516, capital at the beginning of the year. 198.7 yung operating profit. How was this operating profit generated? Capital was provided by the investors to the tune of 1516.4. So what's value created? 13.1. Okay. In order to answer that, guys, okay, you might be tempted to think, yes, value was created because ROIC is positive. Okay. Can ROIC be negative? Sige nga, guys, could you answer that? Is it possible for ROIC to be negative? Yes or no? Have you see the answer of everyone? Can you chat in the chat box, guys? If it's possible for ROIC to be negative. Can you chat? Yes, if it's possible for it to be negative. You see? Okay, Lance, yes. Why, Lance? Why why can it be positive? Sorry. What was your answer? No ba?
Yes, well, no po yung answer.
Okay, no. Sige. Thank you, Lance, for your answer. But let's see. How do we compute for the ROIC? It's no PAT divided by TOC beginning. Okay, TOC, guys, total operating capital, which is your NOWC plus your net PPE. Okay, unless may negative assets yung company, okay, this cannot be negative. Operating capital will always be positive. Okay, how about no PAT? Can no PAT be negative? Take a look at our computation, guys, for no PAT. Is it possible for no PAT to be positive, to be negative? Yes, pwede, guys. Kasi it's coming from your EBIT, no? Okay, so if EBIT is already negative, then your no PAT, of course, will be negative also. Okay? Kasi itatax pa natin yung negative na yun. Alright? So no PAT can be positive, can be negative. So if no PAT is negative, then your ROIC can be negative. Okay, so a negative ROIC means that the company did not perform well. Kasi it's coming from a negative no PAT. And we know that a negative no PAT is bad because, okay, as based on the computation of no PAT, it can only mean that the operating profit was negative. It was negative. Or the operating profit also could be that the operating profit, I think that's it. The operating profit was negative. So when we subtract tax from that, all the more it became negative. Okay, so, all right, ROIC negative, that's possible. Okay, but we can say, guys, that ROIC is good because it's positive. The answer, guys, here lies in the WACC. We're going to go back to WACC. How much was WACC? So let's write here WACC. And we're given that the WACC is equal to 8%. Okay. So what's the decision rule, guys? If the ROIC is greater than WACC, okay, then value was created. Okay, so let me write that. If the ROIC is greater than the weighted average cost of capital, then value was created. Okay, let's take a look at that here. Our ROIC is 13.10%, and that's greater than the WACC of 8%. Therefore, there was creation of value. Okay, so that's how we identify. Of course, if ROIC is negative, then it cannot be greater than the WACC. Okay, because the WACC will always be positive, guys. No way for the weighted average cost of capital to be negative. Okay. All right, a negative ROIC will definitely be less than the weighted average cost of capital, which is always positive. All right, so here in this case, we're given the after-tax cost of capital is 8%. Therefore, value was created for shareholders because ROIC was greater than the weighted average cost of capital. Okay. All right. Any questions so far, guys? Paki-chat nga kung clear so far yung discussion natin ng return on invested capital. When we assess the return on invested capital, we always compare it with the weighted average cost of capital. Okay, clear ba so far? Okay, paki-chat naman, guys, kung yes or no, guys. I hope I get more than 20 responses. Please, guys. Because important sa akin yung feedback. No? I would like to know if so far, guys, clear yung discussion ko up to this point, up to ROIC. Okay, let's wait for a few more responses from your classmates. Okay, thank you. Thank you. So let's wait for a few more responses. So far, we have just reached 1/3. I'm hoping that we can reach even up to 80% response from everyone. We haven't reached 50%, guys. Kindly give me feedback. Thank you. A few more, guys. Yes, thank you. Thank you. A little over 50%. Waiting for some more responses from the class. If okay, so far yung discussion natin ng ROIC. Okay, let me check, guys, if yes yung mga. Okay, thank you. Looks like clear naman so far. Okay, no questions. Okay, thank you for that. Okay, thank you. Okay, so if there are no questions about ROIC, we now go to the next measure. We said that we're going to use MVA, market value added. Okay, if you recall, guys, based on the initial view we had about our text, about chapter 28, we went through the text and I pointed out to you some measures that's used in order to evaluate whether a company is able to create value or not. Then one of those measured there is MVA. Okay. So let's learn how to compute for the MVA, market value added. In order to compute for the market value added, okay, we have to first learn how to compute for market capitalization. Market value or market capitalization. Okay. So we're going to include this in our computation. So kindly insert here let me just mark it here. Okay. We have to know how to compute for market capitalization, and then we're going to compare that with your book value. Okay. Now, how do we compute for market cap or market value? We compute for market capitalization by multiplying the stock price, which we're given at 65, multiplied by the number of shares. Okay, we're also given the number of shares, but this is in thousands. So if this is in thousands and our data is in millions, then we will have to convert this, guys. We will have to convert this in millions. Okay, so 15,000, which is in thousands. How do we convert this in millions? Anyone, guys? How do we convert that into, kasi in thousands siya. Just to be clear about this. Anyone, guys? We're given the shares in thousands, but we need to convert that in millions because our data is in millions. So what's 15,000, which is in thousands? How much is that in millions? Okay, that's just basic arithmetic, guys. Any answer? Ilan yung 15,000, which is in thousands? How much is that if we're going to compute that in millions? And why do we need to convert it in millions? Because our data, guys, our balance sheet class is in millions. So just to be consistent. Okay, guys? Yes. Okay, Shirley, how did you compute 4.015?
Sir, I just divide it 15,000 over 1 million.
1 million. Okay. Okay, thank you, Shirley, for the answer. Kaso, this is already in thousands, di ba? Ano ba yung susunod sa thousands? Millions. So, how many thousands can we get in millions? Yan. Kunyari, ganito ha. This is 1 million. Okay. This is 1,000. Okay. If I'm going to convert, okay. So yung 1,000 na to, in millions, how many is this? Okay. Baka lalo kayong nalito, no? Okay. Ganito na lang, guys. Yung 15,000 in thousands, in order to convert that in millions, well, I will just have to divide this by 1,000. Why, guys? Because there is 1,000 thousands in 1 million. Diba? If we divide this, guys, oops, this divided by this, you get 1,000. Diba? How many thousands do you have in 1,000 to get 1 million? You have 1,000. Diba? So 15,000 in thousands is equivalent to 15 in millions. Okay, so I hope that's clear, no? Okay, so we're given the stock price at 65 and we have to get the number of shares in millions. Okay, so number of shares, this should be in millions. Why are we using in millions, guys? Because all our data are in millions, just to be consistent. Okay, so this is 15 in millions. Therefore, the market capitalization is just multiply this. 65 per share times 15 million shares. Okay, so that's 975 million market capitalization. Okay, really, this is also 975 million. Okay, so the market capitalization is 975 million. Again, how do we compute for market capitalization? We have to know the stock price. Okay, so that we get that from the stock market. How much was the stock price on December 31, 2020? Okay, and how many shares outstanding does the company have? 15 million. Okay, so when we multiply that 65 times 15, that's now the market capitalization. And what we do with this one, what do we do with the market capitalization is we compare that with the book value. Okay, how much is the total common equity or the value of the capitalization in the balance sheet? So we take a look at the balance sheet. Okay, in the balance sheet, we have here, okay, there. Common equity consisting of the common stock and the retained earnings, the total common equity is 940. Okay, so this is now your book value of your equity. Book value because you find it in the balance sheet. Okay, so if you press enter there, we're now able to compare the market capitalization versus the book value. Okay, and if we get the difference between that, this is now called your MVA, market value added. Okay, so if MVA is greater than 0, then you have value was created. Okay, because this means over time, the company has been adding to the value of the equity. In the books, it's only 940. However, if you look at it in the market now, it's 197, 975. Well, in a sense, this is like capital appreciation. Okay, this is capital appreciation. And the MVA is 35 million. Okay, let me pause for a while. Any questions, guys? Is the determination of the MVA clear? And was value created? Yes, value created, since the market value added, which is computed by getting the difference between the book value of equity and the market capitalization. Here we can see that market value added value was created. Okay, just to situate this, guys, ROIC, MVA, and EVA will always yield similar answers. So if based on ROIC value was created, MVA also will show that value was created, and so is EVA. So these three measures are consistent. They're consistent. All right. So any questions so far as MVA is concerned? Pakichat naman please, guys, kung clear so far. Okay, thank you. Thank you. All right. Salamat, guys. I appreciate, guys, your feedback. And if you want me to repeat a particular concept or a particular computation here, please feel free to tell me, and then we'll repeat. Okay. Next, guys, the last is EVA, one of the most powerful measure. Okay, you can check this, guys, in the internet because my Stern and Stewart. These are the this is the company that started this measure, Stern and Stewart. Sorry. You may wish to read on the internet about this, Stern and Stewart. Okay, so again, there's a story here, guys. No? Okay, let's once again go to the same story. It's easier to understand, guys, a computation if we know what the story behind the computation is concerned. Okay, once again, guys, TOC, January 1. And we know that the company was provided with 16.4 million. Okay, so that's 1,516,400,000. This was the capital provided to the company, beginning capital, January 1, end of 2019. Okay, question, what did management do with this? Okay, so we're going to assess management based on what was the capital provided to them at the beginning of the year. Okay, and we know, guys, that until December 31, okay, management was able to generate operating profit. How much operating profit was generated? 198.7. Okay, 198.7. So this is no pat. Okay, is that good or bad, guys? Again, this 115.16 was provided by investors. Okay, remember this is TOC, total operating capital. And operating capital, guys, is provided by investors, whether shareholders or creditors. And based on this capital, guys, the use of this capital, the company generated 198.7 million of operating profit. Okay, now take note, guys, that this one, the capital infused by shareholders, okay, take note that this is not free. Okay, let me write that here. This is not free. What do I mean by not free? This amount was provided by creditors and shareholders, operating capital, not free, which means that they could have used their money elsewhere. So in other words, guys, there's what we call, I know you have met this in your economics, this is what you call opportunity cost. Okay? If I was a shareholder, if I was one of the shareholder, then for me, there's an opportunity cost because I could have placed the money elsewhere to earn interest, to earn returns. Okay? So the investors that provided for this TOC, they demand a return on this. This is not free. Okay? So how do we now charge management for the use of this? Okay, we're going to charge management for the use of capital. So we call it charge on capital. And the sensible thing to do, guys, is to multiply this with the weighted average cost of capital. So in other words, guys, parang interest siya. Okay? It's as if we provided management with this amount and then we're going to charge them for the use of this amount. It's like parang pinahiram natin yung management, no? And how much is the interest rate that we're going to charge them? The weighted average cost of capital. So this is not free, guys. This use of TOC at the beginning is not free. Okay, so let's now compute for that. Okay. So first, okay, let's insert something here. Okay, let me insert two lines here. Dito na lang. I'm going to insert two lines here. Okay. So we have here no path. Okay. We'd like to know if the company was able to generate value for the shareholders. Okay. How much was TOC beginning? Okay, we know that TOC beginning, okay, no path is, let's copy this now. Kindly just insert, guys, the columns. No path, I'll get it from this one. And then TOC beginning, okay, we have it here. TOC beginning, which is, this is TOC beginning, okay, 1516.4. This is TOC at the end of 2020. This is the beginning of 2020. So we're going to assess management based on what was given to them at the beginning, okay, and not the one at the end. So this is 1516.4. And then how much are we going to charge management? We're going to charge management with this one, the 8%. Okay, so this is the after tax weighted average cost of capital. Okay. So why are we going to charge management with the use of capital? Because, guys, this capital is not free. Okay, there's a cost attached to that, and we call this now the charge on the use of capital. Charge on capital. Okay, so how much are we charging management for the use of the TOC? we're going to charge them with this amount. Okay, this amount, guys, 121.3. So they use this capital 16.3. Okay, and that's not free. So we're going to charge management. Oh, sorry, should be here with 8% of that, which is 121.3, and compare it with the NOPAT. This one there. Okay, so management was able to, we call this now the economic value added. The NOPAT was greater than the charge on the capital, which is good. It means that value was created for the company. And that's consistent with the EVA. EVA is positive, then MVA will also be positive. Okay, EVA, if EVA is greater than 0, then value was created. Okay, so let me just copy this format here. There, guys. Okay, value was created. Okay, any questions so far, guys? Any questions as far as EVA is concerned, guys? Okay, let me pause for a while. See? Not sure. Thank you, Karina. About the rest, guys? Any questions about the economic value added? So in order to answer the question, was management able to create value for the shareholders? The answer is yes. The answer is yes. Based on the positive EVA 77.3. Okay, so are there no questions? Okay, clear. All right. So let's have a quick review. It's almost time, guys. I still have one more item to cover here. Based on ROIC, okay, management was able to create value because the ROIC is greater than the weighted average cost of capital. Based on MVA, management was able to generate value, create value for the shareholders by virtue of the MVA greater than being positive, and also EVA. So how did we compute for the EVA? The story behind that is management was provided an operating capital of 16.4 at the beginning of the year. Okay. Now this capital is not free. Okay. So we're going to charge management with the use of this by multiplying this with the WACC. And we call it the charge on the capital, 121.3. And how much operating profit was generated? 198.7, which is greater than the charge on the capital, which is good. So EVA being positive, guys, by subtracting the charge on the capital to the NOPAT, then that means value was created. Okay, another way to compute for the EVA, guys, so let me just show that. Another way to compute EVA. So this is via the ROIC way. Okay. How do we use the ROIC? So first we have here ROIC and then the WACC. Okay. So difference between the two, and then the TOC at the beginning. Okay. So let me just show you another way to compute for the this. So we first look at it based on the ROIC. How much was the return on invested capital? It's 13.10. Okay. Okay, so let me just okay. Then we compare it with the weighted average cost of capital. The WACC is equal to 8%, right? Okay. So based on this, guys, we know that value was created. Okay, because our ROIC is greater than the WACC. So we get the difference. So this is the increment. This is the difference between your ROIC and your WACC. And then we know that the beginning capital provided to management was 16.4. Okay, therefore, okay, the return, okay, the net return on the TOC beginning is equal to the TOC beginning multiplied that by the increment of your ROIC and your weighted average cost of capital. Okay, so there. So we see here that the EVA the EVA is also the same as the one we computed here. Okay, so two ways we did this. First was via the difference between NOPAT and the charge on capital. The second one is the difference between the ROIC and the WACC. So this will yield both the same answer. Okay. All right. So value was created because EVA was positive. Okay. So very quickly now, guys, let me just I have 2 minutes just to recapitulate. So we would like to know if management was able to create value for the shareholders. How do we answer that? There are certain metrics that we can use. ROIC, okay, and then MVA and EVA. All of them revolve around a certain story. ROIC, how do we compute for ROIC? We have to look at the beginning capital, how much capital was provided management, and then how much profit was generated, okay, operating profit. And the ratio between the two is your ROIC, return on invested capital. And we say that value was created when the ROIC is greater than the weighted average cost of capital. Okay. And another way to assess whether value was created is MVA, market value added. Okay. Nakapag-generate ba ng value yung management? How do we know that? Well, we have to know first what's the market capitalization. Okay, the market capitalization is based on the existing current price in the stock market. We multiply the stock price in the stock market by the number of shares. Okay, just take note of the if the figures are in millions, in thousands, it has to be consistent. So the market capitalization is 975 million. Okay, that's the worth of the equity of the company in the market now. But how much is the worth of the equity in the balance sheet? It's 940. This is the book value. Okay, so let me write here, book value. It's what you can find in the balance sheet. So there's a difference between what's out there in the market and what's in there in the balance sheet. 35 million, which means that value was created by management. Okay, since the market value is greater than what's in the books. Okay, and lastly, guys, ROIC, EVA, economic value added. How do we compute for economic value added? Two ways. One way is ask how much capital was given, operating capital, to management at the beginning, 15, 16. Is this free? No, that's not free. Okay, we're charging management for the use of that. Okay, which is equal to the WACC. Okay, now we compare what profit was generated compared to the charge on the capital. The difference is your economic value added. Or you can use the ROIC way by comparing the ROIC with the WACC. Okay, since this one, the difference is positive, so we know that value was created, 77.3 million. Okay, so that ends our discussion, guys. Thank you so much for your time. Then again, reminder, I'm going to post the video on the cash flows. This will be due on Wednesday next week. Okay, Wednesday next week, guys. You have 1 week to work on that. Just view the watch the video, guys, and follow along. Okay, and then you're going to post. I'm going to send this Excel sheet, and then you're going to follow here, guys. Of course, use the formula in the video, and then this one. Okay, and then post it in the Canvas assignment folder, and then that will be transmuted into 10 points short quiz. Let's add that to your short quiz. Okay. With that, guys, I hope you learned something today. Maraming salamat. It's 12:31. Thank you for your patience. And have a great day ahead, guys. Please keep safe. If you have any questions, please feel free and remain. Okay? Thank you. Thank you, everyone.
Thank you, sir. Ingat
Maraming
po
salamat.
kayo.
Ingat din
Thank you,
kayo,
sir.
ha? Thank you, guys.
Thank you,
sir.
Thank you, sir.
Salamat.
Sir, tanong pala dun sa homework.
Yes.
Ito po yung ano, diba, dito yung itong cash flows na to specifically.
Yes,
This
yes.
one.
I'm going to send this, no? Wala ito dun sa ano sa
okay
worksheet
po.
natin. Isa-send ko and then follow the video which I'm going to post, no?
Oh, sige po. Thank you po, sir.
Thank you, thank you. Magpapacheck na attendance, sino?
Sir,
Yes.
narag po.
Nara,
11:09
Nara,
po.
Renz,
Yes,
okay?
sir.
Sige, Renz. Thank you. Thank you, Renz.
Thank you, sir. Thank you, sir.
Okay. Thank you. Who else?
Which section po in the Canvas po na ipopost for recording to review po about the topic today po?
Sorry.
Which section po of the Canvas?
Yung sa atin. Yung sa atin lunch, yung K37.
Okay po. Thank
Oo,
you.
doon ko naman, dali ha. Di ba if you take a look at our modules, which is K37, no? If you take a look at our modules, yan, lahat ng mga video natin yan. This was the latest session we had, October 27. So yung mga videos natin, andi dito lahat, no? If you take a look at our previous classes, andi dito siya.
Thank you, sir.
Okay, thank you, Lance. Okay, no more questions, attendance. Okay, thank you.